It's already November, which means I'm once again late on reporting my quarterly results. And the HODL Factory had a solid third quarter, but was once again slightly outpaced by that pesky S&P 500. If you're new here, the HODL Factory is what I call my individual stock portfolio that I run alongside my ETF portfolio. I co-manage it with my longtime best friend, Hutch. We have a lot to cover this quarter, and I hope that you like data, because this nerd is about to go ham. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you get value from these videos, tap that like button and consider joining the channel membership. Your support keeps the content flowing. I usually save my affiliate link shoutouts towards the end of the video to keep things moving, but you may have been waiting for this one. Seeking Alpha is having a nice Black Friday sale for nearly a month in time. This one will be active from November 12th through December 10th. And if you've been waiting around for the right deal to sign up for Seeking Alpha, you can see on the screen here that the premium service, the one that I use and recommend, is on sale for $240 per year, down from $300. And it also comes with a free 7-day trial if you want to see what it's all about first. I wanted to give this a quick shout out because it's a great way to support the channel. I do get paid for signups and, way more importantly, to save you money for using the link. It's a win-win. You know what time it is. Let's grow. The HODL Factory. Hutch and I have both been successful in beating the market for over a decade with our ETF investing strategies. But none of our ETFs, from VOO to VGT to SCHD to QQQM, gave us that perfect mix of quality companies that we wanted to hold long term. After many nights of drinking too much wine and debating our favorite investing factors, we finally agreed it was time to build our own ETF. And that's when the HODL Factory was born, back in April of 2023. We begin the process with a Seeking Alpha screen that filters out the companies that don't meet our criteria. From there, I use my Excel skills to build a weighting scoring system that narrows the list down to 20 holdings. We stick closely to our passive methodology to avoid making emotional decisions, but I did build in a little flexibility in one of the most recent updates, and we'll look more into that later in this video. We compare our results to the S&P 500 because YOLO. And to be clear, the HODL Factory isn't here to replace my VOO holdings. It's here to complement them. Let's see what's been going on inside this thing. Quarter 3, 2025 portfolio changes. I'm about a month late to cover the third quarter happenings, story of my life at this point. But if you're investing in the HODL Factory or competing against it just for fun, I've got some great news for you. Every Friday, I post a detailed update, completely free, out there in Excel and Google Sheets. It includes my exact holdings, performance data, and a few other cool stats I'll walk through later in this video. We made 2 holding changes to the HODL Factory after our quarterly meeting back in September. Let's see how this thing shook out. In this section, we're going to cover the spreadsheet that we keep on the HODL Factory, and then in the next screen share, we'll dive into the Snowball analytics for specific performance. So we're starting out here on a very basic tab, and this one just shows our drops for that quarter. Hawkins was dropped, unfortunately. It was our best performer, but it ranked outside the top 100 for the 3rd consecutive quarter. And when we took a look, and I'll show you on our decision-making tab here in a minute, we decided to give it the boot. And then Texas Pacific Land, it missed the screen altogether. I think payout ratio and a few other things. It has really sporadic results. It was way up and way down. And it was in the energy sector, which we were looking to offload some of. So it actually worked out perfect that it missed the screen, because when they miss the screen, we drop them. And now on to the next tab. I alluded to this earlier. This is the new manual intervention decision-making model. We run the screener and then we do a weighted scoring system. And you can see the companies that scored the highest. This is their rank on the current racked and stacked, fully scored quarterly system that we run. And we have the ones that we're going to drop, and that's Hawkins. And we decided to get rid of it with it ranking out for the 3rd time in a row, like I said earlier. And we'll look at the key metrics here. I think they're off the screen, so let me cover this other stuff first. And then TPL is out. It doesn't even have key metrics because it didn't make the screen, so there's no tables for the data to pull from. And I'll explain this real quick before I hide it to get more stuff on the screen. When we're coming out to make our decision, decisions. We have the ones we may drop. And at the time, I took them out of the sector since we're dropping them. So this was at 90%. I actually added in the ones we picked, and you can see spoiler alert up here. So healthcare, for example, now has 5%. It wasn't there before. But we have this for reference to make sure that we don't have more than 2 companies or 10% weight of the same subsector or industry. So we have certain sector caps that we'll get into here in a bit, but we recently started capping subsectors as well because, for example, at one point we had 20% energy in the same industry, and much like SCHD, it got us in a little bit of trouble. So now we're paying attention a little more instead of just adding the highest ranked one like we used to. And so this quarter, these were the options here to replace the 2 that were outgoing. And we ended up going with applied materials. And you can see the first 4 here were technology. At the time, we had 1 semiconductor materials and equipment company. So adding applied materials made it 2. And you can see that here, 10% now. This is after the add. So you're getting 100%. And I'm actually going to hide this information quickly. Okay, yeah, now you can see the full screen. And it really came down to applied materials against Lam Research. They're pretty close. Applied materials has a little better CAGRs on the dividend, which we like. Lower payout ratio, higher yield. So besides net income, it's better on a lot of the key metrics we look at. Past performance isn't a huge thing, but they've both done well. And then the PE ratio being 20 in the same industry as the one with 28. We decided to go with applied materials for the quarterly buy. And then it came down to Eli Lilly and Zoetis. And in a similar story, Zoetis had a higher dividend CAGR here, a slightly lower payout ratio, better yield, better net income, very bad past results, but again, that's okay. And then the big one here was the PE ratio, trying to keep our value a little higher, 26 compared to 49. So ultimately we added Zoetis and applied materials. And now moving to the next tab, and we actually use this in conjunction to do some scenario testing before we make our decisions. This one here, and this is live data. You can plug in any ticker that's made the screen. It'll update the sector and key metrics here and all these weighted averages, properly weighted by some product formulas. And so the first thing to mention is on our sector breakdown, we have a 20% cap, but a quarter ago, we decided that technology with today's market can have a 25%. So we had 4 of them only, and that's why we were able to add AMAT, because we upped it to 25 before the quarter. This was no shady business here. And then financials and industrials are currently at 20%, consumer discretionary at 15, and energy at 10. And then you have 5 each of communication and healthcare. So by ticker, you have our stats here, and we're able to plug in Zoetis and applied materials to see what it does to our weighted CAGR. And this data snapshot is as of September 21st when we did this update. So this will look slightly different potentially than what it does here in early November. But our 3-year CAGR you can see is at 20%, 5-year at 19, which crushed VOO at the time of 7 and 5.4 respectively. And then our trailing 12-month yield, we got it a little better than VOO, which I like. We have the huge dividend growth rate, and we're trying to get our yield up to around 2. We want this to be a well-diversified, all-around, all-weather fund that does well in all markets. And so we're just ahead of VOO there. Net income, we really care about profitability because long-term returns on the whole weighing machine concept tend to follow profit. And that's at 28% compared to the market's 13. And then these past performance, of course, this is hindsight's 2020. We didn't have these specific companies for 3, 5, and 10 years. But if we did, you could see they've done pretty well against the market over that time. And then one, we really care about the value side. We want to be that hybrid between SCHD and VOO, a defensive tilt, but still capture more of the upside as well. We have 22 to the markets at the time, 28. So we're really happy with our key metrics and our sector breakdown. We have so many more tabs on this nerdy spreadsheet, but I don't want to spill the beans on our scoring system, which is quite the crazy tab. And then we have some historical ranks and stuff. I think this is the last one you'll probably care about, so I'm not here to waste your time. But these are our current holdings here, and you can see the rows are high numbers. I have all holdings ever, and then the weight of it, I just have hidden the zeros right now to get on screen what's pertinent for now, and that's our current holdings. You can see the sector and the name of the company. We'll get into some of that later in Snowball Analytics, and the subsector here, the date that we added them. But I'm actually going to hide, I think, this information right here, so we can see, there we go. We can see the whole picture. And now Each one of these columns represents a quarterly update. We start here in 4/20/2023. I won't read them all, but we just did 9/21/2025. But what I want to focus on here is our changes over time. So at first we were new, and frankly, we just grabbed the best companies, and we had 40% technology in the beginning, and you can see it slowly scaled down because we put some caps in place, but we really rode the wave of tech, and you'll find out later when we talk about our performance how well that really did for us. But as time went on, we wanted to be, as I mentioned earlier, more of an all-weather fund that does well over the long term. These are buy and hold forever Warren Buffett style companies. That's our methodology. And you can see here on the sold positions, 25 sells back in the day. And we were getting up to like 43 total holdings. We were just adding and experimenting. And we decided to nuke it here. And this is where we had our first, in June of 2024, we had our first sector caps here. And you can see the hard 20. And we've rolled with that. But it wasn't until this one, I believe, that we started to consider subsectors, and then we really cleaned up shop last quarter by going from 25 companies to 20 companies. We want a little more concentration and conviction. And that's, so really there were only 2 drops, but then we dropped 5 as well here for the shaving them. And then you can see here on our September update, we had those 2 drops we just covered. And our new sector diversity, I think, is looking very nice here with 25% tech to capture that upside, but still a good base of the other sectors compared to VOO and QQQM and some of the popular indices. And oh, just for context, we've changed the screen too. It used to be very strict. And now with our current screen requirements, about 200 companies have been making it since making those core changes. So we've been pretty stable for just over a year now. And that's why most of our gains are long-term gains. It's nice to have the lower turnover rate. And it's only going to get better, I think, in time as we figure out precisely where we're headed. And I'm just gonna cover this part very quickly. Now, this is the spreadsheet that's updated every Friday, and it's shared out there in Excel or Google Sheets for free. So if you're following along, you always have access to this. You can see that it was last updated on Friday, November 7th. And I'm recording this on Monday, November 10th. And the market is open right now. So things might get a little wild when we jump into Snowball Analytics. And I won't go too painfully in depth because you can come out and look at this whenever you want. But I'm just gonna cover some high level stuff here. And I'm jumping out to the dividend growth tab. This one's fun because it just shows the dividends paid. And you know, there's nothing spectacular as far as the numbers compared to my main portfolio, if you've been following the channel. But these individual stocks have gone from paying under $10 in the first quarter where we received dividends to 15, 20. And you know, we jump up to 25. And now we took a huge leap as we started to focus a little more on yield. And that's when we made some of those core changes that we've now had for over a year that I was talking about. And a step down, but that's just quarterly stuff here. And you can see we're just stair-stepping all the way to $80 in quarter 3 of 2025. And I think this is just going to keep on climbing. So I really love the dividend growth. This will be fun when we have more years of data to zoom out and remember the good old days. And then I'm not going to bother zooming out. This is just a holding breakdown if you want the true details, if you're competing against me or following along and investing in it. This will show exactly the value I have in each holding at the time, and then some high level stats. And then the last one here is just the first one we showed, and this is just some high-level key data here, and you can see the HODL Factory destroys VOO and SCHD on dividend growth. Its yield comes closer to VOO, but a little ahead of it. Here's the total returns, and the payout ratio is in between, which I really like. Again, it's a bit of a hybrid fund. And you can see here in 2023, we really rode that tech wave. And you know what? If we stayed with it, we would have the same results in 2024. But it is what it is. Hindsight's 2020, and we're happy that we diversified a little bit. But you can see in 2023, we smoked VOO and SCHD. In 2024, we fell short of the market by over 4%, still beat SCHD. And then this year to date in 2025, we were 7% to the market's 12. So the market's smoking us, and then SCHD has been bad. And when you pull it all together and look at the full range, we're up 16% to the market's 24. So we're trailing the market, but I still feel okay long term. And this is out there for anyone to look at any time. Now it's time to get into the good stuff. 2025 year-to-date results. All right, I couldn't hit you with yet another link earlier in the video, but Snowball Analytics really does deserve its own spotlight. It's simply the best portfolio tracker out there if you want to see detailed information about your performance and exactly how you stack up against any ETF. I've got a link in the pinned comment below if you want to try it out for free, and if you like what you see and you sign up, you'll save yourself money and you'll support the channel, just like the Seeking Alpha link. Let me show you exactly what Snowball Analytics looks like and why it's so incredible at what it does. Okay, we're out in Snowball Analytics and we're on the dashboard here by default. I should quickly mention, I do my investing in the HODL Factory with M1 Finance, and you can see the M there, and it is linked. So this is 100% automated. I do not enter a single thing on this. It does everything for me each week. But what I should mention is that each of these 20 companies is allocated 5%, and M1 Finance automatically buys the dip. For example, Zoetis recently crashed on its earnings. Holy Moses. It was down like 16% or so. And this week I just looked. It's actually not there yet because it'll sync tonight because M1 just bought it today as I record. I put all $102, that's a 100 contribution that I do weekly, plus $2 of dividends or something, or just surplus from somewhere else, into Zoetis, one buy. So what it does is it automatically buys the dip, and that's just my default action. You know, last week you can see here that it bought DR Horton, EOG, MasterCard, AGM, and PHM. And it put in, you know, the amount of money that ultimately gets them balanced out. So without any work, I love that M1 Finance, now this isn't Snowball related, M1 Finance automatically buys to the target allocations every week. I just put in the money and say go. And I love that as a value investor. Now here on the dashboard, we are in the HODL Factory. Again, everything linked up via M1 Finance. Our value is sitting at $30,710. And our total profit since April 20th, 2023 is at $4,600, 16.4%. That's not too shabby. And that's an annualized return, the IRR, kind of like your CAGR, your annualized return of 15.53%. You can see the current holdings are 11.51, so there has been some profit taking, like Hawkins, for example. And the passive income, yeah, that's what I thought. So our yield is up to 1.42%. I love that. But you guys, a 5-year CAGR of 20.4%. I wasn't exaggerating on that spreadsheet. And you can see that annually, that would bring in this combination here, I love Snowball, would bring in $436 of dividends. And so here on the dashboard, I love this first one. You can just see by sector what you have. And you can see Infotech is 26, so it's ran up a little. It'll get fewer dollars from the target allocations. But one thing I like about this is you can look at your sectors, you know, and I won't recap them all because we saw earlier, and you can see here with your eyeballs. But if you click Infotech, you can see, like you see Applied Materials, KLA, Monolithic, Badger Meter, and Microsoft just boom right there, and their specific performance. And I love that. And you can hit back and it just goes to the total picture. So you can drill in on these things, both on the information side, if you click here, or on the chart side. It's really handy. Now I came out to the analytics common tab here, and this just shows our holdings. There's other ways to see the holdings too, but one thing I love about Snowball Analytics is site-wide it includes dividends. So when I go to returns and I sort by total profit, these figures that you see on the screen will have the price appreciation, and unlike Seeking Alpha, E-Trade, Fidelity, dividends received also roll in. So you have dividends received, capital gain, realized versus unrealized, and then the total profit is everything. So you see your true return on these, unlike everything else I've ever used pretty much. And you can see now KLA is our big dog, up 86%. And I'll just go down these quickly. Caterpillar's been a great holding here, and it's up 63. Monolithic Power is up 40%. You have Parker Hannifin. I was just deep diving into this one yesterday. It's been pretty impressive here at 39% total. And again, this is just my profit. If I just bought one or if I've held it for a long time, these will vary a lot. It doesn't necessarily mean which one's better than the others. This is just specific to my holdings. And then you have Applied Materials already zooming up there. That's pretty crazy. Williams-Sonoma is relatively new. Microsoft, PHM. I'm just going to quickly go through these. Nexstar Media. This one I added last quarter. It's done pretty well. Visa and MasterCard. We've had them for a while. Dr. Horton on the building side there. First Citizens here up 5%. That's our last gain. And then we're into our losers. And it's a lot of energy and financials. So we have AGM here down 3%. Devon Energy almost working its way back up to even. It's been a little better lately, down 5. Badger Meters had some struggles, but I still think it's a good buy at 7. Same with EOG at 7. That's energy. And then Carlisle CSL is down 9%. Old Dominion, it's really hurt me, and we keep on holding it because it has some impressive stats at 17. And then Zoetis, our new position is down 17%. Bazinga, that hurts. You know, it is what it is, and I believe in it in the long term. Okay, I promise we're finally to the good stuff. We're on analytics growth, and there's so much more in Snowball Analytics, but I can't make this a 2-hour video. I will say this is the area I use 95% of the time. So when you get out here, everything's linked, like we said, analytics growth. Now this is incredible because it will break down your specific performance, dividends included across the board, by the way. This is all total return, and you can pick your benchmarks. Now in our case, I'm gonna go with the S&P 500 or VOO and SCHD because I would love to beat both of them, but at least compete in all markets and just long-term excel over them. And really I'm looking at SCHD because that's my main value holding in my ETF portfolio. I could trickle in more HODL Factory instead of that alongside VOO. So there is a reason. It's not just because this one's been doing bad and like, oh, let's put one we can beat. No. This is my actual second largest holding behind VOO. Now, on the portfolio value, I love this one because I'm at all right now. And all this is saying is if I would have put every dollar when I put it in, you can see invested, couple hundred we started with, slowly ramped it up. And the invested here is the teal one. And you can see the other ones here. But it shows the journey of, and you can see we were smoking the market, by the way. That's when I was riding high, and then energy, and we kind of had an SCHD-like problem. Boom, that hurt. In December last year, we lost our huge lead over the market. And we'll get into that later. But this is just showing if I put every contribution when it happened into VOO instead of the HODL Factory, I would have $2,100 more dollars or 7%. Okay, ouch. If I put every dollar into SCHD, I would have $3,300 fewer dollars. So we're in the middle and doing okay, and you can see what it looks like here zoomed out. Now that's all cool and everything because at the end of the day, this is the scorecard that really matters, but we want to get a lot nerdier than that. So we come down here to portfolio performance, and this is the actual profit on the portfolio. Oh, and I got to hit compare, and we're set to all by default. I guess I'll just show you the whole picture here. So when you zoom out, you can see we started back here and we were crushing it with our tech heavy portfolio, way ahead of VOO by over 10%, and crushing the field, crush the field. Here's that December I was talking about. Whoa, that's a big slide. But anyway, we're making up some ground right here, and then lately we've fallen behind a little bit again. But you can see here that from a profit perspective, we're at 16.5% on our portfolio. And again, with the same contribution in the same flow, VOO is up 25.6%. Wow, it's got us by 9% now. And SCHD is only up 4.9%. But we're here for Q3 data because this is, after all, the Q3 update. And you can see here that in Q3, we were up 4.5%. The market was up 6.8%. So it outperformed us pretty handily. And SCHD was right behind us. It's actually been a lot better compared to what it's been doing at 3.42%. You can see it's made up ground late with the few crashes in the market. So for the quarter, we're losing to VOO, but we're looking okay. And then I'll come down here to 2025, and this just shows the month by month. We won't go over all these. You can see we're the blue bar. But starting with July, we lost to the market, but smoked SCHD here. And then us and SCHD in August crushed the market. That's when we had that little pullback and things were looking a little frightening. We're up over 5% each here, where the market was up 2%. But then in September, the market did the same, only opposite. And, well, we were right there with SCHD again. We Lost, won, lost on the quarter. And as you saw above, overall, we slightly were outperformed by the market. And you can see the market got away early in quarter 4. So far, not looking so good. And actually, just to see what that looks like, coming back up here on the performance year to date, the HODL Factory is up 7.5%. I'm happy with that. The market, yeah, it's having a good day. This is slightly different than the spreadsheet, is up nearly 14%. And SCHD is just barely better than flat on the year. So I like where we're at, but we are falling a little shy of the market. And now from a holding perspective for HODL Factory specific, because it's fun to compare to the market, but sometimes it's just good to look at what you're doing too. We did have Hawkins way up here, but it is now gone, and KLA Corporation is now our number 1 holding at that 87% total returns. And then we have CAT, which has been on fire in 2025, up 63%. And again, we are on all right here. I'll get to the quarter as well. And I won't read everything down the list, but you can just see eyeballing our loser is Zoetis already, which is sad. ODFL, and then the energies have been pretty bad as well. BMI, gosh, I hope that one gets up there. But when we look at, let's zoom into year to date. You can see that's where KLA is seeing pretty much all of its return. We've had it for a long time too. And then CAT, same story. I was saying that one's been good. Monolithic Power. And Parker Hannafin's been solid too at 25% this year. AMAT's a new position. It's up 16. I love that. And then Microsoft. Again, I won't read them all, but here's how we performed for year to date. But then the last one that makes sense is quarter 3. And quarter 3 is July, August, and September. So there's that quarter. And wow, see, we have a little change. Where's KLA is down here. I mean, it's still been great, but it's funny how different companies run away in different time frames. Like Dr. Horton just going ham here. And then Monolithic, it's just been awesome for us in general. Nexstar, so communication doing okay. And Williams-Sonoma, I like to see that with the retail. And Devon, I knew it's been doing better. EOG's been struggling, but I feel like Devon's been on the turnaround lately. And then we have a lot that are flat. These big payment processors like MA and Visa have been fairly flat lately, but they have great metrics. Awesome growth and dividends and things like that. BMI struggled early on in the quarter. It had, I think, an earnings report and a big drop, sort of like Zoetis now. Speaking of Zoetis, yeah, there it is. Up 1.2%. We just had it towards the very end. So, hey, it was up 1% before it lost everything. Yay. I wanted to quickly touch on the dividends before we get out of here. You can see the yield is at that 1.42%. Yield on cost is a little higher. And you can see by position, the yield on cost. I really like that. This is a cool chart down here. There's that annualized dividends, that 20% dividend CAGR. But what I really wanted to show here is the passive income diversification. I love this because your higher yielders, like for us, Nexstar, EOG, AGM, Devon Energy, they show you that they receive 13, and 10% of the total dividend income respectively. So you love to have your high growers, but it's also good to have those payers as well. When you average it out, you get quality dividend stats like 1.5% yield and 20% growth. It'll rate your dividends on reliability, but one thing I really use out here a lot is the dividend calendar. So this thing's pretty neat. Like you can see in November, we're here on the 10th right now as I record this. MasterCard paid me yesterday. That was that $2, by the way, when I put in $102 to Zoetis this week. M1 Finance does it all for me. But then we have one coming up from Caterpillar for $476, Dr. Horton, Williams-Sonoma, and Nexstar. And you can see the day it's going to be paid, the total amount, and these are accurate. You know me, I'm that guy that's always auditing everything, and these have been pinpoint so far. So I love just the look ahead, and you can change the months. I usually just stick in the current month because that's good enough for me, but this has been a cool dividend companion. Snowball Analytics is honestly just a dividend investor's dream, but it's also the best to compare your actual performance. If you don't just want to rough estimate it, you could say, hey, how am I doing to the dollar against VOO? Not like, oh, VOO is up this much over 3 years. I was up that. No. Every single contribution, exactly how you're doing. I need that kind of stuff in my nerdy life. And if you feel like you need it too, hit up my link. Try it out for free. See what you think. Let's pull it all together to find out where we're headed next. Closing thoughts. Hutch and I have been at this for about 2.5 years now. It's funny because we both recently took a step back and asked ourselves, what's the game plan here? Are we trying to be a dividend growth machine that outpaces SCHD's CAGR? Are we trying to beat the market? Are we looking for downside protection? And honestly, we both just said yes. At the end of the day, we want to hold quality companies that will excel in any type of market over the long run. It really is that simple. I genuinely believe this thing has incredible staying power, and I can't wait to keep going on this journey with all of you. And speaking of an epic journey, I want to give a huge shout out to all of my channel members out there, and particularly my 2 new channel members, Green Rhino and Sean D. Thank you so much for joining the Financial Freedom Friends, and your support really means a lot. I don't do any sponsors on this channel, $0 and 0 cents. I just have my couple links and this membership, and the support goes a long way, and it helps keep me motivated. And of course, I'll never forget a huge shout out to all of you on the screen now that have been here all along. You are much appreciated. And check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Deuces.